We're jumping straight into Coinbase Global today. Everyone is watching the price action, but the real story is the massive shift towards stablecoin revenue. It's Saturday, February 14th, 2026. So happy Valentine's Day to the markets, I guess. And we have a really fascinating situation on our hands.
We really do.
The company reported earnings yesterday, and on the surface, I mean, it looked like a bit of a mess.
A big mess. Yeah.
They missed revenue estimates, quarterly sales dropped, and, usually that is a death sentence for a stock. But the market, it did something completely unexpected. Coinbase stock surged to $145.73.
Right.
It rose nearly 10% during the day and then just ripped another 18% higher in post-earnings trading. It's wild.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we unpack this massive move, please do us a quick favor, subscribe, and hit the like button. It really helps us keep simplifying the complex world of finance.
It does.
So we're digging deep today. Let's get into it.
I was looking at the charts last night, and I almost couldn't believe it. We really need to chew on this paradox because it just flies in the face of everything you learn in, Finance 101.
Right.
Usually when a company says, hey, we made less money than you thought we would, the stock goes down, period. Here, we have Q4 revenue coming in at what? Roughly $1.7 billion. That's down 21.5% from the year before. That is a huge contraction.
It's a big miss.
And yet investors are piling back in like they just announced they found a cure for something.
It does feel like a glitch in the matrix, doesn't it?
Yeah.
But I think this is where we have to separate, the headline algorithms from the actual human thesis.
Okay.
The market is essentially repricing risk, but in real time. Investors aren't valuing Coinbase on what it traded last quarter. They're valuing it on what the company's fundamentally becoming.
So the narrative is changing.
The narrative is changing. For the longest time, the whole criticism was that Coinbase is just a volatile casino. Bitcoin goes up, they feast. Bitcoin goes down, they starve. It was just a purely cyclical play.
Right, and Wall Street hates unpredictability. They absolutely hate not knowing if the rent's going to get paid next month.
Exactly.
No.
But this report, despite that top-line mess, it proved that the business model is pivoting. It's pivoting hard toward infrastructure. It's becoming boring. And in finance, boring is beautiful.
Okay, let's break that boring part down. When you say infrastructure, are you talking about the subscription side of the business?
Precisely. This is the bullish engine that I think nobody was paying enough attention to until now. Subscription and services revenue. It grew 13.4% year over year, hit $727.4 million in Q4.
Okay, that's solid.
But the real star player, the one that I think caused this massive rally, is the stablecoin revenue. It surged 61% to hit $364.1 million.
61% that's a massive number. But I want to pause here because I think a lot of people hear stablecoin revenue and their eyes just glaze over.
They do.
We need to explain the mechanics here. Why is this specific revenue stream so exciting to big investors?
It's a great question. Think of it this way. Traditional trading revenue is transactional. It depends on you waking up, feeling lucky, and deciding to buy some crypto.
Right. If you don't trade, they make nothing.
They make $0. Stablecoin revenue is completely different. It comes from that partnership with Circle over USDC. When you hold USDC on Coinbase, or when the ecosystem uses it, those digital dollars are backed by real-world assets, mostly short-term U.S. treasuries.
So it's interest income. It's the banking model.
It is the oldest banking model in the world. They take the dollars, buy safe government bonds that are paying, 4% or 5%, and they keep a massive chunk of that yield. They don't have to convince you to trade. As long as that USDC exists and is in circulation, the meter is just running. It is high-margin, recurring revenue. And growing that by 61% tells Wall Street that Coinbase is becoming less of a stock exchange and more of a bank for the crypto economy.
That distinction, exchange versus bank, is just crucial for valuation, isn't it? Exchanges trade at lower multiples because volume is so fickle.
So fickle.
But banks, especially with sticky deposits, they command a premium for that stability.
Exactly. If trading volume dries up, they still have that check coming in. But we have to look at the other side of stability, which is the balance sheet itself. I know you were digging into their cash position.
I was, and honestly, the numbers are kind of startling. They ended 2025 with $11.3 billion in cash and cash equivalents.
$11.3 billion.
Yeah. That is up over 21% from the previous year. And to give you a sense of scale, that is enough cash to acquire most of their mid-sized competitors outright, without even asking a bank for a loan.
It's a war chest. And in this kind of rate environment, cash is king. It gives them so much optionality. But what really stands out to me is that they aren't just sitting on it.
No.
They're signaling extreme confidence. Management authorized a $2 billion share buyback program.
That is a huge signal, and I don't think we should just gloss over that. Usually, a tech company in growth mode, they hoard every penny for R&D or marketing. For them to authorize $2 billion for buybacks tells me two things. One, they've kind of run out of things to spend money on internally that offer a better return than their own stock. And two, they think their stock is on sale.
And they aren't just waiting around either. They already bought back 8.2 million shares in the fourth quarter alone.
Wow.
When insiders are aggressively buying back their own stock, it tells you they believe the intrinsic value is way higher than where it's trading. They're effectively putting a floor under the price.
Yeah.
And remember, despite that Q4 miss, the full year of 2025 was actually a record breaker in a lot of ways. Total trading volume for the whole year doubled to $5.2 trillion.
$5.2 trillion. Let's sit with that number for a second. That is a staggering amount of volume. It rivals major traditional exchanges. So even if Q4 was a bit soft because crypto prices dipped, the yearly trend is clearly up.
It is. But I want to circle back to a term that I saw in the report that I think confuses a lot of retail folks. Distributable earnings.
Yeah, yes.
The report mentioned distributable earnings per share of $5.57, which actually beat estimates. Why does that metric matter more than, say, standard net income?
It's a great point to clarify. In modern tech accounting, net income can be really messy. It includes things like stock-based compensation paying employees in shares, which is a non-cash expense.
Right.
It makes the earnings look lower than they really are in terms of actual cash flow. Distributable earnings is a metric that just strips out all that noise to show you the cash the business is actually generating that could be returned to shareholders.
So it's just a clearer picture of the cash machine.
Exactly. The fact that they beat estimates there, coming in at $5.57 a share, means the core business is printing money. The machine works. The adjusted operating income, yeah, it missed a bit in Q4, came in at $0.66, but the annual picture shows a company with serious earnings power.
So we have a cash machine, we have this pivot to stable subscription revenue, and we have a buyback. But every good business needs a moat. In crypto, where you can theoretically trade anywhere, what's stopping someone from just eating Coinbase's lunch?
That's always the fear. But their moat has actually gotten wider, and I think the market is underappreciating a specific move they made last year. First, you have just the sheer dominance in the U.S. retail market.
Right.
Network effects are real liquidity begets liquidity. But the really strategic move was the acquisition of Deribit back in August of 2024.
Right, the derivatives exchange. We've mentioned it briefly before, but let's connect the dots here. Why does this matter today?
Okay, so in the U.S., retail traders mostly do spot trading. You buy Bitcoin, you hold Bitcoin. Simple. But the institutional market, the hedge funds, the pension funds, all that, they live in the derivatives market. They need to hedge. They need to manage risk.
They don't just want to bet on the price going up. They need insurance in case it goes down.
Exactly. And the derivatives market in traditional finance is something like 10 times larger than the spot market. By acquiring Deribit, Coinbase basically bought the keys to the institutional lunchroom. It allows them to service those massive clients in a way a simple spot exchange never could. It just opens the door to massive institutional volume that wasn't accessible before. It's a much higher margin game.
So you have the retail dominance in the U.S., plus a foothold in institutional derivatives, plus the stablecoin utility. That is a very difficult combination for a competitor to replicate overnight.
And we can't forget the macro backdrop here. We got that inflation data yesterday, right?
The inflation yawner, as some people are calling it. The report came in cooler than expected, and that pushed Treasury yields lower.
Right. And when yields drop, risk assets, especially crypto and tech stocks, they tend to fly.
They do. The market is pricing in rate cuts, and lower rates are like rocket fuel for this sector. So you have a company-specific turnaround story colliding with a macro tailwind, and boom, that explains the 18% pop.
But hold on, I'm going to play the skeptic here. We can't just wear the rose-colored glasses and ignore the red ink on the page. We have to look at the flip side.
Fair enough.
You mentioned revenue was down 21.5% in Q4. That is a massive drop no matter how you spin it. If this is such a growth machine, why did the top line shrink so much?
And that is the bear case in a nutshell. You cannot escape the cyclical reality of this industry. The revenue dropped because crypto prices fell in the fourth quarter. It's that simple. When prices go down, retail traders lose interest. They stop opening the app. Volatility drops. Transaction fees they evaporate. And that is still the bulk of their business, despite the pivot we talked about. And the warning signs are there for this quarter, too.
Right. I saw the guidance for Q1 2026. It looked a little soft to me.
It was. Management guided for subscription and services revenue to be between $550 million and $630 million for Q1. Now, remember, they just did over $727 million in Q4.
So that's a sequential step down, a big one.
It is. And they're blaming it on lower average crypto prices and, ironically, lower interest rates.
Wait, okay, let's unpack that irony. We just said lower rates are like rocket fuel for the stock price. How can they be bad for revenue?
It's a double-edged sword, and this is where the nuance is so critical. Lower interest rates mean asset prices, like Bitcoin, usually go up, which drives trading volume. That's good.
Right.
But lower interest rates also mean Coinbase earns less interest income on those reserves back in the USDC stablecoin.
Ah, I see. So the banking model takes a hit when the Fed cuts rates.
Exactly. Since stablecoin revenue was the star performer in Q4, a rate cut environment actually hurts that specific high-margin revenue stream. So the bears are looking at this and saying, your trading business is down because prices are low, and your stablecoin business is about to take a hit because rates are dropping. Where is the growth going to come from in Q1?
That's a tough spot. It feels like they're caught between a rock and a hard place until that trading volume really picks back up. And then there's the elephant in the room. We can't talk about crypto without talking about regulation.
The eternal struggle. And this is where it gets tense. We had a statement just yesterday, February 13th, from a White House crypto advisor. They explicitly said the legislative window is closing for the Clarity Act.
The Clarity Act, we've been hearing about this for what feels like years. This is the bill that's supposed to finally give clear rules of the road for digital assets in the U.S., right?
Correct. And the market is betting heavily on this passing. But here's the risk. If this act fails to pass, if we get legislative deadlock, the massive wave of institutional adoption that everyone is betting on gets delayed.
And why is that delay so catastrophic? Can't they just keep operating as they are?
They can. But institutions, we're talking about the BlackRocks and the Fidelities of the world, they need legal certainty.
Yeah.
They can't pour billions of client dollars into a regulatory gray area. They need to know the rules won't change tomorrow.
So without those clear rules, Coinbase is basically stuck just relying on retail traders.
Exactly. And retail traders are fickle. They flee when prices drop, as we saw in Q4. If the Clarity Act dies in Congress, that whole infrastructure thesis takes a massive hit. The company remains a high-end exchange for retail gamblers, not the backbone of a new financial system. That is the danger zone.
It sounds like a binary outcome. Either they get the rules and become a giant, or they stay in the cyclical trap.
And that leads right into the operating miss. Adjusted operating income was $0.66 in Q4, which missed expectations. So when you combine a missed operating number with soft guidance and all this regulatory uncertainty, you can see why the bears are nervous. The stock rallied 18%, sure, but that could just be short sellers covering their bets, not genuine long-term belief.
So, okay, let's try to synthesize this. We have a stock that just ripped higher on what looks like bad news. We have a huge cash pile, a dominant market position, but a declining revenue stream in the short term. If I'm watching this, what are the specific triggers I need to look at over, say, the next 30 days?
There are 3 or 4 critical things to watch. First and foremost, the political calendar. We need to watch February and March of this year very closely for a vote on the Clarity Act. This is arguably the most important binary event for the company.
Right. Pass equals upside, fail equals stagnation.
Exactly. And that ties back to the White House advisor's comments. The clock is ticking.
It is.
Second, watch the Fed. We had that cool inflation report. Now we need to see how the Federal Reserve reacts. If they actually cut rates, capital is going to rotate further into risk assets. That lifts the price of Bitcoin and Ethereum, which brings the retail traders back to Coinbase.
So that solves the transaction revenue problem.
It solves that problem. But as you said, it might hurt the stablecoin interest income. But historically, the surge in trading volume from higher crypto prices would far outweigh the loss in interest income. They would happily take that trade-off. It's a net positive.
Okay, what about the next earnings report? I know it's a ways away, but what should we be looking for in the trends?
When Q1 earnings roll around, you have to watch the sequential performance of stablecoin revenue. We know guidance is down. But if it holds up better than expected, if it proves resilient even as rates tick down, then that infrastructure thesis is proven.
And if it collapses alongside trading volume,
Then the stock is probably overvalued.
I also saw some rumors floating around about something called the Everything Exchange. Is that Is that real or just hype?
It's speculative, but it's out there enough to pay attention to. There are these rumors of an everything exchange launch a potential new product category for tokenized assets. Imagine trading stocks, crypto, commodities, art, all in one platform.
So instead of having a brokerage app for stocks and a crypto app for Bitcoin, it's all in one wallet.
Exactly. If they launch something like that in 2026, it just completely changes their total addressable market. It's a wild card, but you have to keep an eye on press releases for new product categories.
It definitely feels like they're trying to build the Amazon of finance. Just get everyone on the platform and figure out the monetization later.
That's the vibe. And honestly, with $11.3 billion in cash, they have the runway to try these experiments. They can afford to fail at a few things if one of them becomes the next big thing.
So we have a messy situation. A short-term revenue dip, a long-term strategic pivot, a massive war chest. How do we pull this all together? What's the final takeaway here?
It really just comes down to a battle between two identities. Is this a declining transactional business, or is it a booming utility? The trade right now is a bet on the latter.
It feels like the market has decided to look through the valley. They're ignoring the Q4 dip to look at the future potential.
Exactly. And here's my final provocative thought for you to chew on. The market repriced this stock 18% higher on bad news. In trading, that is usually a sign of capitulation, but in the good way. It means the sellers are exhausted. There's nobody left to sell. Everyone who is worried about the earnings miss has already sold.
That's a powerful technical signal. The weak hands are out.
They are gone. And consider this. With $11.3 billion in cash, this company has a runway of over 2 years, even in a total catastrophic bear market where they make almost zero revenue. They aren't going anywhere. So the question you have to ask yourself is Coinbase just a fancy stock exchange for Bitcoin, or is it slowly becoming the central bank for the crypto economy? That $364 million in stablecoin revenue suggests it's becoming a bank.
And banks are valued very, very differently than casinos.
Precisely. If they succeed in this pivot, and we start comparing them to a JP Morgan rather than a NASDAQ exchange, then $145 a share might look incredibly cheap in hindsight. And that is the lowdown on Coinbase Global. It's messy, it's volatile, but the pivot is real.
Make sure you subscribe so you don't miss the next move. We'll see you next time.